Hi everybody and welcome to the London Session Update with myself, Kathleen Brooks, on Wednesday the 9th of October 2013. Well, it's been an interesting day so far in the markets, or last 24 hours I should say. Still no debt ceiling being raised in the US, we've still got the government shutdown, but it was confirmed that President Obama will nominate Janet Yellen as the next head of the Federal Reserve. She's currently the vice chairman, so it's not too much difference, but obviously she has got very dovish credentials. So a Yellen at the head of the Fed is very more of the same, so probably funnily enough though, the markets are on that. The dollar is higher today. One would have potentially expected the dollar to actually be lower on a Yellen nomination. Likewise, her nomination hasn't been able to soothe the markets. European stocks are down. That follows heavy losses in the US overnight. A spike higher in the VIX as debt ceiling issues in the US really start to bite. Now remember, we're only 8 days away now from a potential technical default in the US, and it doesn't look like Republicans or Democrats, this stalemate that's going on in Washington, is going to be broken anytime soon. We are still hostages to that headline risk coming out of Washington. So markets very, very jittery. And let's take a look at how that's being manifested. So a few days ago even, we weren't really seeing it in stocks, but stocks have continued to fall lower and they've fallen below some key levels, which I'll talk about in a moment. But treasuries is where we've really seen it. Now this is just the 1 month bill yield, or the yield of the 1 month bill I should say, and it has spiked higher. Now it's got to its highest level since 2009. What's interesting about that is that it's surpassed its high from 2011, the last time we had one of these debt ceiling wrangles that really rattled the markets. So what we're seeing is treasury yields really start to show, especially the very front end of the curve. What was more worrying yesterday is that it also infected 2 years. They started to rise. So it's not the nominal level of yields, they're still very low, but it's a pace of increase. And if we continue to see this impasse in Washington, and we continue to see 10, 20, 30% gains in yields every day, all of a sudden the US could have another fiscal issue on its hands, which is an enormous interest bill. However, what this has been translating into is a higher VIX, some big drops in stock markets. Stocks have gone through some key levels. The S&P 500, for example, got through the 100-day moving average. The FTSE 100 fell through 38.2% fib support level today, which really opens the way to 6,000, those lows from June. So what this all means is that even though we're not seeing necessarily, multiple percent drops every day like we would in a potential market panic, we are getting past some key support levels, which means that climbing higher and recovering is going to be a bit harder. So the markets are taking these knocks. They are really getting a bit jittery on the back of the debt ceiling issue. Now, we also had some economic data out of the UK, so it's not just all about the US, but this certainly didn't help the pound. Let's take a look at sterling, the cable rate here. And as you can see, we have fallen through that key 160 level. That comes out on the back of a double whammy, a very, very weak industrial and manufacturing production data for August, alongside a bad news on the trade deficit that widened as well. So these data misses really are adding up now. We had PMI manufacturing data miss last week, and it really suggests that potentially the pound is overvalued above 160. So this fall below 160 is significant because that is a key psychological level. 159.70 and then 159.10, which is the Kijun line on the daily Ichimoku cloud. They are two very short-term support levels that we're going to be watching. But that really is what's on the market's minds today. Do watch what's coming out of Washington and do join us again for more. Thank you.